Hello guys. So we have two sessions down in assessment procedure and we understood the mandatory cases of return filing and we have also understood the due dates for filing return of income. Now, as I told you earlier, section 139 1A, 1B are not that relevant nowadays and they are not even tested or not even part of the syllabus. So you can rest easy on those two areas. Now, let us jump to the next section 139 1C. It is a power that is bestowed upon the central government to make notification on a timely basis as to cases where return filing can be exempted. What did we see so far? Return filing mandatory. Now, return filing exempted. Okay. Now, when has the central government exercised this power? If you see, during the year 2019, wide their notification number 55 stroke 2019, they exercised this power. Why? Now, you must be aware of IFSC. What is this IFSC? International Financial Service Center. Okay. So, what is this? It is a multi service SCZ. So, it is an SCZ that is available solely for the purpose of financial service sector. So, it is available for the financial service sector. So, tax incentives are provided for people who get registered under the IFSC. Fine. In India, we have one IFSC in Gandhinagar, Gujarat. Gandhinagar, Gujarat, called as Gift City. Okay. It is called as Gift City. So, what is this? Gujarat International, International Finance Tech City. So, this is called as Gift City. Okay. Now, the sole purpose of this SEZ is to provide tax benefits or tax relief for international financial services. Okay, so multidisciplinary services like offshore banking units, offshore insurance companies, offshore asset management units, and then capital markets are all structured in an SEZ, multidisciplinary SEZ multi-service SEZ under the name of International Financial Service Center. So here it is called as Gift City in Gujarat. Now, what happened? Let us say that there is a non-resident or a foreign company, okay, and there is an investment fund. What is an investment fund? Don't worry about investment fund details right now. That is a separate topic and its taxation is a separate topic. We will definitely deal with it. Don't worry, I will not lose on my word. I will definitely take you through those topics because they are slightly tricky topics. We'll definitely do that. Okay, so non-resident or foreign company, and there is an investment fund. This investment fund is located in IFSC. Okay, let us say it is located in Gift City. Now, this non-resident or foreign company, he goes and invests in this investment fund, and the investment fund will issue units to these investors. So these fellows are the investors. Now, this investment fund is giving income to these unit holders. Okay, income. They are giving income after TDS under section 194 LBB. What is 194 LBB? When we do investment fund topic, I will definitely take you through the provisions of this particular section 194 LBB. So, IFSC, when it pays to the investor by means of income, it will deduct tax under section 194 LBB and it will remit to the government. Now, the government told, fine, if these guys, investors, have only this income, so they have income only from the investment fund, then there is no point in asking them to file a return of income because the very purpose is to promote these type of transactions so that India becomes strong with respect to international financial services. Okay, and by giving them a waiver of income tax return filing, you are giving them an incentive so that they will be more incentivized towards the investment. Sir, whether there are any exemptions? Yes, there are exemptions that we will separately deal. Non-resident taxation topic, we will take it separately. Don't worry. For the time being, they are, apart from giving an exemption to the income, which we will separately see, they are also given a benefit by means of asking them to not file a return of income. However, that is subject to certain conditions. Condition number one, there has to be an investment fund. That investment fund has to be in IFSC. The amount of payment made to the non-resident or foreign company should be after deduction of TDS, and it should be the only income for the non-resident. These four conditions should be satisfied. If these four conditions are satisfied, then there is no need to file return. So there is an exemption. So then exempt from ROI. Okay, so these four conditions should be satisfied. Condition number one, investment fund. Condition number two, IFSC. Condition number three, TDS on income. Condition number four, only this income. So these four conditions are satisfied. You need not file a return of income. Now, what has happened? Suppose during the year there is a notice given to this NR or FC under section 142(1) or 148. Okay, what are these notices? Don't worry, that is why we are doing this topic. That is a department side that we are going to discuss about. We have still not crossed the assessee's role, so stick on to whatever discussion we are going through right now. Notice under 142(1) is to call for filing return of income. 148 is call for return filing only, but for a different purpose. Okay, so what purpose we will discuss later. So they have called for filing return of income. Okay, if this notice is given, then this exemption is lost. So if the non-resident or foreign company receive notice under section 142(1) or 148 calling them forth to file return of income, then this exemption is no longer applicable. Clear? So this was the first exemption case that was notified during the year 2019. Clear? Now, the latest assessment year which is applicable for your examination, there were two additions made. Now again, I am not going to discuss in detail because it has heavy reliance on capital gains as well as heavy reliance on non-resident taxation topic. So that we will immediately see after this topic, and so that we will have a continuity with whatever topic we are discussing so far. Now, second case. So what is this second case? Now, again, just like this issue, the assessee is either a non-resident or a foreign company. Okay, and he is receiving income. So receives income. So what is this? It is a situation where he is receiving income from what? Specified fund under section 10(4)(d). Sir, what the hell is this? Specified fund under section 10(4)(d) is also called as alternate investment fund category 3. So those are all generally hedge funds which are issued under SEBI regulations of 2012. Don't worry about it. Non-resident taxation topic, we will discuss this particular section in detail. The moment I put those lectures, listen to them, come back here, you will get the total picture. Okay. So what they are trying to convey here, non-resident or a foreign company, the assessee should only be these two. Okay. They receive income from a specified fund under section 10(4)(d) alternate investment fund category 3, and this generally applies to an IFSC as well, and this is located in an IFSC. Then what happens? No mandate of ITR. Is there any other condition, sir? Yes. No other income apart from the above. So what are they trying to tell? There should be certain conditions again here also. What are the conditions? The assessee who is deriving this benefit of exemption should be a non-resident or a foreign company. Second, he should receive income from specified fund under section 10(4)(d). What is that? Alternate investment fund category 3. Now, this alternate investment fund should be located in an IFSC. Now, beyond that, he should have only that income as part of his total income, then he is not mandated to file the return of income. Is it clear? Then he is not mandated to file the return of income. Again, if he is going to be receiving a notice, if he is going to be receiving a notice like here 142.1 or 148, then he is mandated to file the return of income. That's a different story altogether. So is it clear? So this was the latest amendment. This is the latest amendment that is applicable for the May 22 and November 22 examinations. Okay. Now, did they stop with that? No, they further went on. They told, boss, we have addressed one side of the story. What is that? Income. Suppose there is a capital gain that is going to arise. Suppose there is a capital gain that is going to arise. We should address that as well. So they told, fine, one more amendment, non-resident, okay, transfers specified capital asset under section 47 7 AB. See, you will be going through this section 47 as part of your capital gains topic. Fine. So don't worry about it. We will again deal with this provision in detail when we do NR taxation and capital gains taxation. But for the time being, just try to absorb the provision. When we do those, you will be able to relate this one. I will once again repeat at that juncture as to boss, here we have one more issue. We have to connect it with the assessment procedure topic. So don't worry, I will definitely take you through. Sir, if you're going to do it, then why are you doing it now, sir? Because I want you to have a continuity and completeness of the topic that we are dealing with. That's all. Okay. Now, so NR transfers specified capital asset under section 47 780. Then what happens? This should be in a recognized stock exchange in IFSC. This transaction should happen where? In a recognized stock exchange in IFSC. If it happens in a recognized stock exchange in IFSC and the person transferring is a non-resident and the asset transferred is a specified capital asset, on top of it, consideration in foreign currency. There should be a consideration which is paid in foreign currency. If these conditions are satisfied, no mandate of ROI. So, what are the conditions? Assessee who is transferring the asset is a non-resident. Asset transferred is a specified asset or specified under section 47(7)(ab), and then the transfer should happen in a recognized stock exchange which is located in IFSC, and then the consideration for this transfer should be received in foreign currency. Now, what is the specified asset, sir? So, it is going to be foreign currency denominated bond. Okay. And then you can also talk about GDRs. Then you have units of AIF, alternate investment fund, which we saw here. So which we saw here, and then you also have units of mutual fund, etc. Now, don't worry about the specified fund. We will deal with it twice, one during capital gains and one during our non-resident taxation portion. Just remember the provision of exemption here. Okay. So, what are we talking about here? Number one, exemption that the central government is empowered to give for assessees from filing return of income. Exemption number one, investor should be a non-resident or foreign company, and income should be received by the investor after deducting TDS under section 194 LPB from an investment fund which is located in an IFSC, and this should be the only income of the non-resident or foreign company. Then they are exempt from filing return of income. Case 2. Non-resident or foreign company receives income from a specified fund, receives income, interest, dividend, etc. Okay, from a specified fund under section 10(4)(d), which is going to be on account of alternate investment fund category 3. Okay, that we will discuss separately. And then this should be located in an IFSC as well. then it should be the only income he has to receive. There is no mandate to file return of income. Third case, non-resident has transferred specified asset under section 47(7)(ab). What is specified asset? As I told you before, foreign currency denominated bond, GDRs, bonds, etc. will get covered here. So that we will see as part of section 47 as part of capital gains, and also as part of 10(4)(d). We'll separately be looking at it from capital non-resident taxation point of view. And this transaction of transfer should happen in a recognized stock exchange which is situated in an IFSC. For this transfer, the amount of money that is received by the non-resident should be in foreign currency, not in INR. If these conditions are satisfied, then there is no requirement to file return of income. One more point: these two cases, that is case 2 and case 3, that is alternate investment fund case and the 47AB case, if all the conditions are satisfied, PAN is not mandatory. PAN is not mandatory. If all the conditions are satisfied, two benefits are given. Benefit number 1, PAN is not mandatory. Benefit number 2, what is it? You don't have to file return of income. Is this clear? So these are the exemptions that are given towards filing return of income. One was given way back in 2019 and the other two were now recently given for the assessment year 22-23 onwards. With this we have completed section 139(1)(c). Now let's move on to the next section. Suppose I have incurred a loss for a particular year. Is it mandatory for me to file return of income? If I am a company, partnership firm, whether loss, whether gain, I must file. Correct? So that is already ruled out. It is already ruled out. Now let us say, for example, I am an AOP. I am an AOP. I have incurred a loss for the current year. Should I file the return of income? Because blindly reading the provisions of section 139(1), for AOP, basic exemption limit of 2,50,000 will be applicable. Now, I will go ahead and tell boss I have incurred a loss. I have not met the basic exemption. So why should I file a return of income will be the point of argument. Correct? Now, many people started taking up this argument. They never filed the return of income. 2-3 years down the line, when they came into profits, what they did was they started filing return of income by showing very small amount of income. Department questioned, how come your income is so low and you have not even filed return last 2 years? They told, sir, last 2 years we had losses. We did not meet the basic exemption threshold, so we did not file return. This year we have income, but we have carry forward losses from the last 2 years. No, based on your provision only we have set it off. Then the department told, these guys are not doing the right thing. How do we know whether this loss is genuine? We need to have a check over the losses. So let us make a provision. So they brought in what is called as section 80. What did they do? In section 80 they told, you can carry forward loss, you can set off loss. But for the purpose of carrying forward, of A, business losses, then B, capital losses, both short term and long term, then losses from owning and maintaining race horses, and then loss 4 was with respect to your speculative business. For losses corresponding to these 4, if you have to carry forward in the year of incurrence, return must be filed within 139(1). Okay, so 80 told you will have to file return of income if you have to carry forward the loss. Now this 139(1) was told by 139(3). Section 80 told boss, file the return of income if you want to carry forward and set off the losses. 139.3 told boss, you file the return of income within the due date specified under 139.1 if you have to carry forward or set off losses. So we are now looking at 80 and 139.3 together, which is section 139.3. Section 139.3. So what is this section 139.3 telling you? Section 139.3 is focusing on the requirements for the purpose of set off and carry forward of losses. Now, if you read this carefully, you will know that I have specifically listed the losses. I have specifically listed losses. So 139.3 tells that if these losses are to be carry forward and set off, you will have to definitely file the return of income before the due date under section 139.1. Now, let us understand why they have given this 139.1 time limit. Because if you ask me, there is one more time limit called as time limit for filing belated return. Time limit for filing belated return, which we will study subsequently under section 139.4. Why are they stressing on 139.1? Because what people started doing, if it is not specified as 139.1, people will start manipulating the losses. They used to have a lot of time earlier. They used to have a lot of time, so there was almost a year's time. So by that year's time, I can create fake expenditure, I can pass fake accounting entries, enhance the loss, and so I will be claiming higher benefit of enhanced losses when actually I should not be having those many amount those of that amount of losses. So to avoid such manipulation being done by the assessee, what the department wanted to do was, boss, you file the return, but you have to file it within this first due date, which is your regular return due date. I will not give you the benefit of loss carry forward if you file it beyond this particular due date. Clear? Now, what else did they tell? They have specified business losses, capital losses, owning and maintaining of race horses, and speculative. Some of you might question me, sir, what is the problem in not including your depreciation, unabsorbed depreciation, and let us say even the house property loss, which we study as part of your this thing set off and carry forward loss as part of your intermediate syllabus? Why is it not getting covered? That could be a common question. Okay, so let us try to address that. HP. What is the loss under HP? If it is a self-occupied property, I have taken a house loan and then I'm claiming the interest of 2 lakhs. That is going to be the maximum benefit I can claim. Correct? So that is going to be the maximum benefit I can claim. So they are giving me a cutoff. I cannot go beyond that cutoff. Right? Just a second, guys. Sorry. Okay, so there is a maximum limit that is being emphasized with respect to the loss that you can claim under the head house property. You cannot go beyond that. So there is a limit, and so you cannot manipulate this house property loss. Now, what about depreciation? Unabsorbed depreciation. In unabsorbed depreciation, how do you compute unabsorbed depreciation? You take the loss and you see the depreciation component and you remove it. You tell that business loss is 100 rupees and depreciation, IT depreciation charged in that is 60 rupees. So 60 rupees is unabsorbed depreciation, balance business loss is 40. Now this depreciation, how do you compute? Opening WDV, additions, you remove the deletions, that receipt of money from deletions, and you arrive at the WDV and you charge depreciation. Now, this depreciation that you charged is based on actual expenditure in fixed assets, and you have a percentage which is applied. You cannot manipulate the percentage, you cannot manipulate the useful life like Ind AS. Here you have a fixed percentage and you have to go based on that only. There is no useful life concept. So if that is the case, There is no question of manipulation that can happen in these two losses. That is why there is no strict rule with respect to filing the return of income within the due date. Is it clear? Is it clear? Now 139.3 and 80 specify the conditions for carry forward of loss and set off of loss. So be very careful in understanding it is the condition for carry forward of loss and for set off of loss. Now let us do one thing. We'll take an example now. Just a second, please. Sorry. You can look into your handouts. Let me take it. Yeah, so example one, ABC Limited not covered under TP provisions. So when question talks about not covered under TP provisions, they are trying to hint at the due date. What is the due date? ABC Limited, it is a company and they are not covered under TP provisions. So due date of filing return. Due date of filing return is going to be 31st October of the assessment year. Okay. Assessment year here is 22-23 in this question. Therefore, 31st October 22. Okay. Income details are PGBP 15 lakhs and other income other than salary is 3 lakhs. Okay. So, what is the total income? Filed its return of income on 2012-2022. Sorry. So, due date and actual date of filing return. Read the question. Sorry. Is 20th December 20th December 2022. Sir, can they file like that? Don't worry, we have not yet discussed 139.4 which talks about belated return, which gives us a time limit up to which investment can be made. So just wait, we will go through that. Now, so this 20th December 2022 is the actual date of filing return. Now, based on this, we are given that PGBP loss is 15 lakhs. And other income other than salary is 3 lakhs. They have asked what is the total income for assessment year 22-23 and what is the loss that can be carried forward. Now please understand 139.3 and 80 are putting a restriction on carry forward. It is putting a restriction on carry forward. It is not putting a restriction on set off. It is not putting a restriction on set off. So for AY 22-23, total income will be nil. Why? I will offset this loss to the extent of 3 lakhs. I will offset PGBP loss in other income to the extent of 3 lakhs. And then loss carried forward nil. Why? Because due date of filing return is 31st of October, actual date is 20th of December. I have filed the return of income beyond 139.1 due date, so I am not eligible to carry forward this loss. However, both 80 and 139.3 restrict only carry forward. They don't restrict set off. Is it clear? Therefore, set off is very much permissible. That is why I have set off and I have told total income for the current year is nil. Loss carried forward is also nil. Why not? Why can't I carry forward this 12 lakhs? Why can't I not carry forward this 12 lakhs? Because I have filed the return of income beyond the due date prescribed under section 139.1. Is it clear? Yes. Now, let us go to the next situation. ABC Limited filed its return of income for AY 22-23 on 12/10/2022, well within the due date of 31/10/2022. Fine. What we will do is let us slowly tackle the problem itself directly. So, due date of filing return. What is it? 31/10/22. Actual date of filing return. What is it? 12/10/2022. So have they filed it within the due date? Very much within the due date, because due date is 31st of October. They have filed the return on 12th of October. Now let's continue. So during there, what has happened? Business loss is 10 lakhs. Okay, and then so are they eligible to carry it forward? Yes. So loss carry forward to AY 2023-24. How much is it? Entire 10 lakhs can be carried forward. Now, for the assessment year 23-24, due date of filing return always remains the same unless until amended 31st October 2022. But when have they filed the return? Actual date of filing return is 12/12/23. Sorry, this is 23. 31/10/23 is the due date of filing return. Actual date of filing return is 12/12/2023. Now, what has happened? There is a business income of 5 lakhs. So, business income. They have a business income. How much is it? 5 lakhs. Okay, so they are asking us to comment upon the carry forward of losses. So current year, what can I do? I will have a brought forward loss. I will have a brought forward loss. Now, can I set it off? Yes, I can. For setting off and for carrying forward only, there is a restriction. Please understand. For carrying forward, there is a restriction. When the year in which loss is incurred. So, restriction to carry forward only in year of incurring losses. Now, loss was incurred when? Loss was incurred in AY 22-23. Was I eligible to carry forward? Yes. Why? Because I filed the return within the due date. This year, have I filed within due date? No. Can I set off? Very much yes, because there is no restriction on set off. It is only a restriction on carry forward. Therefore, brought forward loss, how much is it? 10 lakhs. Therefore, leftover loss 5 lakhs. Can I carry forward? Can I carry forward? Yes, you can carry forward. You know why? Because year of incurrence only they are restricting you. Try to understand the intention. They want to ensure that the year in which you incur loss, you have filed the return on time and you have not manipulated the losses. If you have done that, there is no question for them to come and question you subsequent year. Once you are done it right, they cannot come and stop you even if you file it belatedly for the subsequent period. Okay, so the restriction is only in the year in which you incur loss. For the purpose of carry forward, you have to file within 139(1). Subsequent year, suppose the same loss still gets carried forward. Here, this 10 lakh got set off to the extent of 5 lakhs. Still 5 lakhs of loss is left over. Loss is left over. However, it is not current year loss. It was the last year's loss. I have complied with the provision last year. So I am very much eligible to carry forward this loss of 5 lakhs. Therefore, loss carried forward to AY 24-25 is 5 lakhs. Clear? So this is the provision that I want you guys to understand with this example. Fine? Now, so let me repeat. In the year of incurrence, you have to file return of income within 139(1). If you do so, you will be eligible to carry forward. The moment you carry forward, subsequent year, there are no losses, but you have got income after setting off the same loss you are going to carry forward, you will still be eligible if it is a return filed beyond 139(1), because restriction is only in the year in which you have actually incurred the loss, not for the year for subsequent carry forward. The year of incurrence, I file it on time. 6 years after that, belated return, still eligible for carry forward. Understood? Now, third example. This will further clear our understanding. So, what is the third example? ABC filed its returns for AY 22-23. So, an extension of the previous example, 22-23. Due date of filing return was 31/10/22. Actual date of filing return was 12/10/22. So business loss is how much? 10 lakhs. Unabsorbed depreciation is going to be 4 lakhs. Can they carry forward? Yes. Both carry forward to AY 23-24. So you can carry forward to the subsequent assessment year. Now what has happened to the subsequent assessment year? AY 23-24 due date of filing return doesn't change. It is going to be 31/10/23 due date of filing return for AY 23-24. What is the actual date of filing return? It is 12/12/23. Now, what has happened during this year? During this year, business loss is 2 lakhs, unabsorbed depreciation is 5 lakhs. Okay. Now, my question to all of you, what will be the amount of loss to be carried forward for assessment year 24-25? Business loss that I can carry it forward, unabsorbed depreciation I can carry forward. Business loss I can carry forward only 10 lakhs. Unabsorbed depreciation I can carry forward 9 lakhs. Why? Business loss can be carried forward only if the return is filed within the due date. Here have they filed it within the due date, so I am eligible to carry forward. So I am carrying it forward to next assessment year 23-24. It is not being set off, and there is no restriction on further carry forward. There is no restriction on further carry forward. Therefore, I am happily carrying it forward to the next year. Come to unabsorbed depreciation, 4 lakhs. They are not bothered whether you file the return of income within the due date or beyond the due date. You are always eligible to carry it forward. So straight away I am carrying it forward to assessment year 23-24. What happened in assessment year 23-24? I further incurred business loss of 2 lakhs, unabsorbed depreciation of 5 lakhs. Here they are telling me that, boss, this you cannot carry forward. Why? Because the due date of filing return was 31st of October, but I ended up filing only on 12th of December. So I lose the right to carry forward business loss. And this loss is incurred in the current assessment year. For the year of incurrence, I have filed a belated return. I will not be eligible to carry forward the business loss. So this straight away gets rejected. However, unabsorbed depreciation, no matter when you file the return, you are always eligible to carry forward losses. That is why you are eligible to carry forward losses here. Okay, so unabsorbed depreciation is 9 lakhs, which is what? 4 plus 5, whereas this is this 10 lakh which we already incurred for assessment year 22-23. Okay, hope you have understood. I have given these 3 examples in your handouts. The examples will have the answer as well. Okay, because before I give it to you, because right now while I'm recording there is no answer, but when I give it to you it will be with the answer, so it will be easy for you guys to understand. Okay, now some of you might feel, sir, suppose there was an earthquake, the building crashed, and that building only had the server where the books of accounts are maintained, and that building only had the person who was taking care of taxation. His laptop got crashed. To restore the entire thing back to normalcy, it took 2 months. Between this time, we had completely lost out. We were unable to file the return of income. Now you are telling we cannot carry forward loss also. Our company is already into losses. This loss now only we are recouping, and next year we will get a huge insurance claim, and that when we put to tax will become a headache. Please help us out. This is what people came out asking. Then the department told, fine, don't worry. There is a power that is given to CBDT. What CBDT can do is condone delay for carry forward of loss. So what is the meaning of condoning delay? They will accept your delay, and then they will allow you to exercise the benefit of carry forward even though you have filed beyond this due date. So you will have to make an application, return application, and then you will be eligible to carry forward the loss. Now, can whom should they apply to? If the loss is up to rupees 10 lakhs, up to rupees 10 lakhs, you can make an application to CIT, Commissioner of Income Tax, or Principal Commissioner of Income Tax. If it is greater than 10 lakhs, up to 50 lakhs, Up to 50 lakhs, you can make it to Chief Commissioner of Income Tax or Principal Chief Commissioner of Income Tax. Beyond 50 lakhs, you have to make an application to CBDT. Sir, what is this 10 lakhs, 50 lakhs, beyond 50 lakhs? The loss for which you are going to make a continuation of delay. Current year loss is up to 10 lakhs, apply to CAT or PCAT. Current year loss is beyond 10 lakhs up to 50 lakhs, please apply to CCAT or PCCAT. Beyond 50 lakhs, apply to CBDT. Sir, will they definitely give us? Apply and pray to God. May God be with you. They will definitely look forward to giving you the benefit. Okay. Now, so this is with respect to the provisions of section 139.3. Okay. So 139.3 should be read with provisions of section 80 as well. So you will have to file it within the due date specified under section 139.1. And this provision will restrict you from carry forward of losses corresponding to business income, also with respect to capital gains, speculative businesses, and owning and maintaining of race horses. However, it will not apply to unabsorbed depreciation and house property losses. And then whether it applies to this year of set off or year of carry forward, the source of the loss has to be checked. Which year is the loss incurred? You have to file return of income on time for that year alone. Subsequent years you may file a belated return. However, you will still be eligible to carry forward and further carry, so set off and further carry forward. Okay, so this is with respect to section 139.3. Now let us move on to the last section for the day, section 139.4. What is that? Belated return. Sir, I was unable to file within the 139.1 due date, sir. Sir, what can I do? Do you mean to say that I can never file? No, there is still a possibility for us to file the return of income. Earlier, up to last year, the time limit was till the end of the assessment year or completion of assessment. Till the end of the assessment year or completion of assessment. For the assessment year 22-23, it is now getting modified and they are specifying that it is going to be 3 months before due date, 3 months before end of assessment year or assessment completion. How do we understand this? Let us take assessment year 22-23. What is the completion of assessment year? 31st March 2023. So 3 months before. So exclude March, exclude February, exclude January. Therefore, 31st December 2023 or assessment completion. This assessment completion is more theoretical. Generally, assessment will not be completed in such short span. Generally, assessment will never be completed in such short span. Okay, so 31st, sorry, it's not 23, it is 31st December 2022. Sorry, 31st December 2022. So I am an individual. Due date of filing return under 139.1, 31st of July, assuming that no other conditions, a tax audit is not applicable, TP is not applicable, 31st July. What is the time limit for belated return? 31st December. I am a company for whom transfer pricing provisions are not applicable. Due date for filing return of income 31st of October 2022. However, if I have to file a belated return 31st of December 2022, I am covered by transfer pricing provisions. 30th of November is the original due date and 31st of December is the revised due date. Original due dates are split between types of assessees. Belated due date is a singular due date irrespective of the type you get covered for 139.1. Under 139.1 you might be transfer pricing, you might be tax audit, you might be other cases. For 139.4 you are belated. You are given only time till 31st of December. Okay, so this is the provision with respect to belated return. Now let us understand this assessment completion so that you will be able to appreciate this provision. See, there is one type of assessment called as ex parte assessment. That is the department, as I told you before, assessment procedure is a dialogue kind of process. Assessee does something, department replies. Department questions something, assessee replies. So there has to be participation from both the sides. Suppose Department keeps asking, assessee is silent. What they will do is they will process the assessment without the assessee's involvement. This is called as ex parte assessment, or without the other party assessment. Now, it is also called as best judgment assessment. Don't worry, we will look at this when we get in detail with respect to the department side of assessment procedure. Now, what has happened? For example, there is, let's take example number one. Mr. A failed to file the return and the AO completed the assessment on ex parte basis on 30th September 2022. So, due date of filing return for Mr. A, let us take it is 31st July, because if he is doing this ex parte on 30th of September, he cannot be a person who has to file on 31st of October. So it is implied for a person whose basic due date itself is 31st of October, assessment cannot get completed on 30th of September. So it is deemed that it is 31st of July 2022 is the due date. Actual date of filing return not applicable because he has not filed. Now, as of now, what is the time limit for 139.4? 139.4 will be 31st December 2022 or assessment completion, whichever is earlier. So the officer has sent a notice asking Mr. A to file the return. Mr. A has not responded. So assessing officer has got irritated and he's finished the assessment to the best of his knowledge. And the date when he completed the assessment was 30th of September 2022. Can Mr. A tell that, boss, I have time till 31st of December, you should allow me to file the belated return? No. He is finished because he has not complied with the provisions of 139.4, which is giving you a time limit of this or that, whichever is earlier. Completion of assessment or 31st of December, whichever is earlier. Here the completion of assessment has been earlier, so he cannot file a return of income. Clear? Now, example 2. Mr. B failed to file the return of income under section 139.1 before the due date and filed the return on 17th November 2022 for AY 22-23, whereas due date of filing return due date of filing return is what? 31st of July 2022. Now, AO completed the assessment on 13, AO completed the assessment on 13/11/22. Okay, and served the order to the assessee on 21st November 2022. Now, whether this return filed 17th of November return filed, is it a valid return or not is the question. Now try to understand. Completion of assessment or 31st of December, whichever is earlier. So what is the meaning of completion of assessment? Is it the day when I receive the order in my hands, or is it the day when the order is signed? It is the day when the order is signed. It is the day when the order is signed. So when is the assessment got completed here? The assessment got completed on 13th of November 2022 itself. I received it at a later date. That doesn't mean that I have time. So this is not a valid return. It is not a valid belated return at all. This is not a valid belated return at all. Is it clear? So this is the provision with respect to belated return. Now, let us quickly go ahead and see what will be the outcome if I choose belated return over regular return. I don't file the regular return. I have decided to file the belated return. But if this becomes a regular practice, it will become a nuisance to the department. So they ensured that they will not encourage this practice. So they brought in certain consequences. So consequences of 139.4. So the first thing that they told was, boss, if you file your return of income beyond 139.1 due date, you will be eligible for fees at rupees 5,000, or if your net total income, net taxable income, not total income, net taxable income is less than 5 lakhs, then it will be rupees 1000 rupees. Why this 5 lakhs? Because you have this rebate issue, so there will generally not be any sort of taxation for other assessees. Okay, so if I file a belated return, what happens? Up to 5 lakhs, my fees is rupees 1000. Beyond 5 lakhs, the fees that will be charged from me will be rupees 5000. Okay, so this was consequence number one. They inserted a section called as section 234F. Okay, now you might have noticed some of these people who go abroad will want to file the return of income for past visa purposes. So what they will do is they will file belated return because they wouldn't have filed earlier, but their income will be very minimal, 60,000, 1.6 lakhs. They'll have such incomes, but they wouldn't have filed because they have correctly complied with 139.1. But now, for purposes other than for income tax, they would have filed. Suppose there is one Mrs. Meenakshi. So one Mrs. Meenakshi who's got taxable income, net taxable income of 1.2 lakhs, 1.2 lakhs. She files the return of income on, let us say, 12th of December. 12th of December. Is she required to pay this 1000 rupees? Answer is no. You know why? Because those who are required to file the return, if they don't file within the due date, then this fees will be applicable. Is Meenakshi required to file the return? No. She has voluntarily chosen to file the return. Therefore, there is no fees that will be applicable for Meenakshi in this case. Is it clear? There will be no fees that will be applicable for Meenakshi in this case. Now, then, yeah, so let us continue. What else will be the consequence because of belated return? Section 80, we just saw in 139.3. We will not be eligible to carry any losses that we incur. Then, one more consequence. Now, this section 80A, AC, sorry, section 80AC talks about the benefits given by 80I series. In chapter 6A deductions, you will be looking at certain income-based deductions. Income-based deductions, for example, 80IA, IBA, etc. Those you will not be able to enjoy. If you need the benefit under those sections, you must file the return of income before 139.1 due date to enjoy the benefit of 80AC with respect to income based deductions under section 80I series. Okay, then suppose I have to file the return of income. On top of it, I have to pay taxes as well. I have not paid taxes, so I have to pay taxes. Then what happens? 234A interest will be applicable. So whatever is the tax payable into 1% into number of months or part thereof. So that will be the interest. So into number of months or part thereof. Don't worry about the computation. We will look at it when we do the interest topic, because there's a separate topic for interest under 234A, B, C, D, etc. So there we will look into the computation part of it, but just understand, because of delay, and there should be a tax payable. If there is a no tax payable case, the question of 234A will never arise. Okay, so in that case, interest will also be payable. Now, is there any other case, any other issue because of this or consequence because of this? As we had already told you in one or two examples earlier, one or two examples with respect to 139.4. What did we tell? Ex parte assessment or best judgment assessment. Because you have not filed the return of income, or there is a delay in filing the return of income, if the assessing officer gets annoyed, he can complete the assessment to the best of his judgment, which is again a problem to the assessing. Okay, so this is with respect to ex parte assessment. And last disadvantage of filing the return belatedly will be interest under section 244A. This is the interest that is given for refunds at 0.5% per month or part thereof. Now, if I file a belated return, what will be the outcome? I will get the interest from date of filing return till date of refund. So what is the meaning of this? Generally, if I file a return which has refund receivable from the income tax department within the due date under section 139(1), they will give me an interest starting from 1st of April of the assessment year till the date when I receive the refund. 1st April till the date of refund. But if I file a belated return, suppose the return is filed by the assessee 31st July assessee, if it is filed on, let us say 30th July, he will receive interest from 1st of April till 31st of July. But if he files the return of income, let us say that he files on, he's filed it on 31st or 30th of July, he's receiving the refund on August 31st. He will be eligible for interest from 1st April to 31st of August. So assessee should file before 31st July. He filed on 30th of July. He's getting the refund on 31st of August. His interest will be from 1st of April till 31st of August. One more assessee, he is also eligible to file the return of income on 31st of July, but he has filed it on 10th of August. He has filed it on 10th of August, and the refund is again given on 31st of August. Refund interest will be given only for 1 month, only for the month of August. So this is the next downfall with respect to filing a belated return. Fine. So with this, we have completed the provisions of section 139(4) as well. So what all have we seen in today's session? We have seen about section 139(1)(c), which talks about 3 cases where there is an exemption. Case number 1, non-resident or a foreign company who have invested in an investment fund located in IFSC, and this investment fund, when it pays to the non-resident or foreign company, it deducts TDS under section 194 LBB and deposits to the government. And this is the only income of the non-resident, then they are exempt from filing return of income. However, the exemption will be tested if there is going to be a notice received under 142(1) or under section 148. So should we remember this section number? See, there is no mandate. The institute is not mandating you to remember, but it is better because your ability to withhold will be far stronger. We'll anyways find a way to do that, don't worry. Then, second case was with respect to 10(4)(d), income that was given from alternate investment fund category 3 specified fund by a non-resident or a foreign company, and that be the only income, and that the alternate investment fund should be located in a IFSC. Then this income being the sole income, there is no mandate to file return of income. 47(7)(ab) case, again IFSC and specified fund, non-resident, and it should be in an IFSC. Consideration should be in foreign currency. Then there is no mandate to file the return of income. This non-resident foreign company with 10(4)(d) case and 47(ab) case, PAN also is not mandatory. Okay, so these were the exemption case under section 139(1)(c). Then 139(3) read with section 80 specified that business loss, capital loss, owning and maintaining horses loss, and then speculative loss can be carried forward subject to the income tax return being filed within the due date specified under 139(1). Okay. However, house property loss and depreciation unabsorbed need not be done so. And then we also understood that the restriction is only applicable in the year in which loss is incurred, not for subsequent carried forward. Also, the restriction is only for carry forward of loss, not for set off of losses. Okay, then we went on to understand that there may be a continuation of delay, and there is a limit of 10 lakhs, 50 lakhs, and more than 50 lakhs to CAT, PCCAT, CCIT, and CBDT. Wherever there is CAT and CCIT, there will automatically be PCIT and PCCAT as well, respectively. Then we went on to understand section 139(4), which talks about belated return, where you feel that you are unable to cope up with the timelines and you have lost out on 139, you can go ahead with 139(4) and file the belated return. Time limit is going to be 3 months before the end of the assessment year, which is 31st of December, or completion of assessment, whichever is earlier. Generally, completion of assessment is not going to be a problem. It is always going to be 31st of December only. Then, what did we see? There are certain consequences of doing this. What are the consequences? When we look at the consequence, 234F fees will be charged. 5,000 if your total net taxable income is more than 5 lakhs. If it is lower than 5 lakhs, your fees under 234F is going to be 1,000 rupees. Then, if you have tax payable and you have not filed the return of income within 139(1), you have a 234A interest which has to be paid at 1%. Then you also have a reduction in the refund interest received under 244A. You will get the refund from the date of filing return till the date of receipt of refund, unlike the original cases where you get it from 1st of April till the date of receipt of refund. Then what are the other consequences that we saw? Section 80AC. What is it talking about? Income-based Chapter 6A deductions cannot be enjoyed if you don't file return of income within the due date. And then Section 80, which restricts carry forward of loss, will also be applicable. Therefore, you cannot carry forward loss if you don't file the return of income within the due date. With this, we have completed 139.1, 139.3, and 139.4. The next focus will be on section 139.5, which talks about revised return, and then we will go to defective return 139.9, and certain specified returns for certain specified exempt organizations are also there. So that we will be taking in the next lecture. Okay, thank you, please.